Hi, I'm Ben Reppond. Welcome to my presentation on how we invest money. The reason I'm doing this is that I get asked from time to time, how do we invest money? What methodology do we use? What's the philosophy behind that? And so I thought I would do a presentation to talk about the detail of how we invest money, the philosophy, the decisions that we make, and how we make them, why we make them, etc. I think this will explain a lot of that. First, I want to tell you a story. In this slide, you see three men. In the center is Joseph Kennedy Sr. To his right, your left, is Joseph Kennedy Jr., who was killed actually in combat in World War II. To his left and your right is John F. Kennedy. Joseph Kennedy Sr., I believe the date was probably in July or August. We don't know the exact date, but somewhere before September of 1929 was walking down the street in New York City. He stopped to get his shoes shined. And as he was there, the shoeshine boy started giving him stock tips. And afterwards, after he paid the boy and walked away, he thought to himself, when the shoeshine boy is giving you stock tips, it's time to get out of the stock market. It's interesting, I don't know exactly the day he got out. I don't know what stocks he was invested in, but I do know that he's conveyed his thoughts about the process that led him to get out of the stock market. Not only did he get out of the market, he actually shorted the market. We don't know which stocks he shorted. Maybe it was the same ones he had bought. Maybe it's different ones. We don't know the day he shorted them. Shorting is very risky. You're betting against the stock market, so you need to have incredible conviction and nerves of steel to short normally. But he was so convinced that his gut feel was right that he shorted the market. That's just what he did. I don't know what the conversation was, obviously, between him and his stockbroker. But I would imagine that that stockbroker was getting calls every day. I want to invest. I want to invest. I want to get on board. My friends are making money. I want to make money. And that stockbroker was probably filling those orders one after another until the day, and he answered the phone, and on the phone was Joseph Kennedy Sr. saying, I want to sell everything I've got. That would have been an interesting conversation. We don't know who the stockbroker was. We don't know any of those details. All we know is he got out of the market and he shorted the market. And that happened before September, October 1929. In 1929, it is recorded that Joseph Kennedy was worth about $4 million. In today's dollars, in inflated dollars, that is about 59 million. It is recorded that he, in 1935, 6 years later, was worth 180 million. That's over 3 billion in today's terms. I'm sure some portion of that came from shorting those stocks. Perhaps he has made some other investments when prices got attractive that helped increase his net worth. All we know is those dollars. So Joseph Kennedy had uncommon sense, an uncommon gut feel for when the market seemed risky, and somehow the conversation with the shoeshine boy seemed to trip that switch in his brain that said, I need to get out. The stock market goes through these cycles where the market goes up and it goes up and it goes up, and we almost don't even pay attention to it. We're pleased, but it goes up. The economy could be struggling. The economy sometimes is even going down, or the economy could be going up. They tend to go in just different directions sometimes for different reasons. But part of the cycle is that the stock market goes up until it doesn't. And then one day, the merry-go-round stops. The music stops. And the stock market goes the other way. And all or a lot of what was accumulated evaporates. It's gone. People become devastated. I'm not talking about a minor correction. I'm talking about a collapse. And people are not prepared for it. The financial advising industry and the financial planning industry does not deal with the concept that you need to get out of stocks at a time when stocks start to collapse. They don't believe in that. They think you should have these kinds of assets together, some stocks and some bonds, some commodities, some foreign stocks and little precious metals, this and that. They put it all together, and then they believe that you just write it up and you write it back down, whatever that means. And we'll get into that later. But when the stock market goes through a crash, you've seen them before, they do happen. The stock market does go through these cycles, and you have to endure it. This is an outline of what I'm going to cover. I'm going to start with the goal. The goal is minimize risk and optimize rate of return. So we want to prevent as much of the downside experience in the stock market as possible, and we want to fully take advantage of the stock market when it is going up, both sides of it. We're going to look at some historical patterns. The historical pattern of the stock market, interest rates, and inflation. All of them contain risk, and we're going to look at all three of those. We will also look at conventional approaches to investing, and then our approach, which is different. We're going to look at it in a rising market of equities and in a falling, declining market in equities. So we'll see it from all sides. And I think I will be able to explain what we do and why we do it so that it makes sense. When I went back, I did a search on the historical market crashes, and I found that since 1800 to present, there have been about 22 stock market crashes, if I counted correctly. This would be a market that goes down at least 30%, equities go down at least 30%, maybe as high as 90%. I'm not going to go through all of those, but I did select the last three major market crashes. There are others in the last 50 years, but these three would characterize what a typical bear market or down market would look like. The first one is 1973 to 1974. This one is extremely interesting to me because a lot of market conditions were present in 1973 that are actually present today. And for example, an environment of rising energy prices, gas prices, rising interest rates, stock market risk, inflation risk, those kinds of circumstances surrounded the environment in 1973-74. So this crash, I think, is instructive. It looks like this, like the blue line on the chart. I circled it from the beginning to the end, and it went for almost 2 years, for a period of a little over 20 months, and the stock market dropped. In this case, the S&P 500 dropped about 48% during this 20-month period of time. As you can see, the market doesn't just go straight down. The market goes down and then it tries to go up, and then it collapses and then tries to go up again and then collapses. It just keeps going through this up and down period, every time trying to go up, but the weight of the sentiment is so negative that it pushes it all the way down. So that would be an example of one bear market. The second bear market would be a period of time that was called the dot-com crash or the dot-com bubble, which went from a period of 2000 to early 2003. So a period of about 3 years, and the stocks from the NASDAQ or the NASDAQ 100 went down about 75%, and the S&P 500, which included a lot of technology stocks, but also included other stocks, it went down about 38%. So again, you can see it goes up and it goes down. It goes up and it goes down. But in general, the trajectory is down until the market becomes completely exhausted. The third condition I want to show is in 2008. This is more recent, so we probably have more memory around what happened in 2008. In 2008, we had the stock market crash. It resulted from financials and real estate related stocks that were overvalued. There was a systemic problem with those industry sectors. And then the bubble burst and the market came down. As you can see, not unlike the previous slides, that the market went down and then it went back up. It went down and back up. A series of those constantly going up and down, but the trajectory was down until the market eventually became completely exhausted. Why is this important? The traditional conventional investment professionals, the investment industry, doesn't teach the investment professionals to deal with this in a way that they get out of the way and preserve your money. What they do teach is you put stocks together usually with other kinds of assets, but usually a lot of treasuries, treasury bonds, or bond funds. And the goal is for those to soften the downside risk of equities. The problem is that they put a huge drag on the rate of return when the market is not collapsing. So yes, there is, at least for the last 40 years, been a historical period where treasury bonds have provided some degree of cushion against downside risk, not completely at all, because assets still collapse. We'll take a look at the future, but for this period of time, this is the kind of risk that investors are facing, and then we'll come back to bonds and see what kind of protection those are going to be for the future. This is a chart that spans a 150-year period of time, going way back to 1870. And it shows the S&P index, the S&P Historical Composite Index, going from 1871 to present. It does two things. One, it puts the data, the line chart, on a logarithmic scale, which illustrates the percentage of change, not the dollar amount of change. As such, it makes this slide more realistic. The second thing that makes it realistic is that it's inflation adjusted for the buying power of the dollar. So when you see the blue lines that go up and the red lines that come down, those are very realistic based on those two adjustments. There's a line, a red line, that cuts all the way through the middle of it, and that's a regression line showing the portions which are above that line, and then when it's below the regression lines, when you are in negative territory relative to the norm. Excuse me, I put 3 down arrows on the right side of the chart to illustrate the same 3 periods we just looked at. 1973-74, which actually went all the way out to 1981 time period. So it went for quite a period of time, spanning at least a decade, maybe a decade and a half, until it finally exhausted itself in about 1981, maybe even early 82. And then it took off. And then the second arrow is the 2003 dot-com bubble crash. And then that followed a few years later with the housing crisis and that crash. And since that time, the market has, generally speaking, gone up, represented by the blue line at the right end of the chart. And here we are today, sitting at the top of that blue line, highly exaggerated to the upside, higher than it's ever been numerically, and higher than it's ever been on a logarithmic chart and adjusted for inflation. So any way we can find to pull that number down, it still is the highest in all of history. My green arrow at the right side of the chart is a question mark. Do you think this is going higher and higher and higher? And when does it stop? Elevations are already exaggerated to the upside. Or do you think it will follow the patterns of the past and recognize this as a period of high risk, and the money, the big money, and people who get frightened by a market declining start to exit the market, and then we go into a period of decline? At some point, based on historical patterns, we are going to go through a period of deep and prolonged decline. You can see how that has happened over the past 150 years. It is always preceded by this period where stocks get elevated, and then it is followed by a period of deep and prolonged decline. Or that black arrow, is it going to go down from here, or is it going to go up from here? Or is it going to go up before it goes down? We don't know that. But we do know historical patterns, and it does not look encouraging. Abby Joseph Cohen is the global chief investment strategist for Goldman Sachs. Bloomberg and CNBC love to have her on the TV, on their shows, as often as she'll come on, because she is a good representative of the institutional side and maybe the retail investor side of the business. And so they want her thoughts. She's very smart. She's very measured in what she says. And they want her on the TV telling, what are your views? You're speaking for Goldman Sachs. And I would go on to say, you're not only speaking for Goldman Sachs, you're speaking for the investment industry. At the end of 2007, in December, before 2008, they had her on and said, what do you think is going to happen in 2008? Keep in mind, in October of 2007, that was the top of the market. The market had already been in a period of decline for a couple of months before they asked this question. So there's already an indication of what's starting to happen. And they said, what do you think is going to happen? And she responded with, she thinks the market, in this case she's using the S&P 500, is going to increase in value about 14% in 2008. Now, what did she know and what did she say? I don't know. That turned out to be a very false statement, a very false prediction. The market declined 56%, the S&P 500 declined 56%. Some people's investments declined more, some people's investments declined less. But on average, if we use the S&P 500 as our indicator, the market went down 56% from its high in October of 2007 to its low in March of 2009, when it became totally exhausted and began its climb upward. In 2008 itself, the decline was 38%, but the total decline was 56. She was saying probably what a lot of professionals, investment professionals were saying, is just put your money in the stock market. It's going to keep on going up. But it didn't work out that way. I want to tell you about another story. It was 2009, and every day I would take my two youngest kids to school, and I would go across the street to the coffee shop, and I would have a cup of coffee, and usually find a friend and had a cup of coffee. So I stopped, went inside, stood in line for my coffee. I recognized the guy in front of me. He's a friend of mine. His daughter was in the same class with my daughter, and from behind I said, "Good morning, Bill, how are you doing?" And he turned around enthusiastically with a big smile on his face and shook my hand and said, "Good morning, Ben, I'm doing fantastic." Bill was a contractor in Seattle. The housing market had begun its collapse. The stock market had already collapsed, but it was starting to affect the real estate market, and it certainly affected contractors and developers. At least in Seattle, and I think throughout the country, they were going bankrupt right and left. I knew this, so I said, "Bill, I'm glad you're doing well. I'd like to know more about how you're doing well." He said, "I would love to tell you the story. Get your cup of coffee and come over and I'll talk to you." So I got my coffee, sat down with Bill, and he told me the story. He said this. There are two parts to his story. In 1999, 8 years before then, he was building houses in Seattle, and a young man that worked for him came into his office and said, "Bill, I'm going to give you my resignation. I'm going to quit." And he said, "Why are you going to do that?" He said, "I found an easier way to make money." He said, "Well, tell me about it. Maybe I want to do it." And he says, "It's easy. You just borrow $50,000. In my case, I'm going to borrow $50,000 and I'm going to buy Microsoft stock with it. Every year it doubles." At that point, for 15 straight years, Microsoft stock had approximately doubled every year. So his statement was correct. His assumption, however, was flawed. And Bill said, "Are you sure?" And he said, "Yes, I'm sure. You can't miss." Okay? He took his resignation. The young man walked out. Bill closed the door. And he reported to me, he said, "I called my stockbroker and said, sell everything I've got." And the stockbroker said, "Bill, I don't understand. Why are you doing this? I get calls all day long about people that want to buy stocks because every day they seem to be going up, 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 up. Why are you selling? I don't understand. Tell me, why?" And Bill said, "It's very simple. They just reeled in the last sucker." What did Bill see that maybe others did not see? Maybe even his stockbroker didn't seem to see. Is Bill's story similar to Joseph Kennedy? I think so. He took an everyday example and looked at what is the indicator here and what is it telling me? What other people quit their jobs and did something like this, and people did not connect the dots? Go forward till 2007, so this would have been about 2 years before my coffee with Bill. He said, "I'm building houses in Seattle." Another young man comes into the office and hands me his resignation. And he says, "I'm going to quit." "What are you going to do?" He said, "Well, I'm going to get into your business. I'm going to build houses, because when you build a house, somebody buys it and you make $150,000. You can't miss." And Bill said, "Are you sure?" He said, I'm sure. Took his resignation. The young man walked out. Bill closed the door. He called his wife. He reported to me, and he said, I've decided I'm going to sell the business. Bill, why are you going to sell the business? Because they just reeled in the last sucker. Take a personal example. I'll go back to 2007. I had sold my company and was in my final year of my employment arrangement with the new company, and it was my plan to leave in October of 2007. And I had money to invest. I made the last payment, and I contacted 3 national banks / brokerage firms and a large regional firm. And I got proposals from them on how I should invest my money. I didn't know much about the investment industry. I was an outsider. I probably knew as much as the average person. And I got those proposals, and they all look risky to me. To me as an outsider, I didn't really understand them. I couldn't, repeat much of what I had heard, but they all looked risky to me. That was the one thing I remember. They all looked risky. So I decided that I would not take their recommendation, and I would, in fact, put my money in cash. I didn't know what to do, but it just felt like investing in the stock market at that time seemed risky. Now, I'm not clairvoyant. I'm certainly not as insightful as Joseph Kennedy or probably my friend Bill, but it just was a gut feel that it was too risky, so I didn't do anything. Following October 2007, I watched the stock market collapse and saw people lose huge amounts of money, and I was sitting in cash. All of a sudden, it started to feel like maybe I'd made the right decision. When I got to 2009, then I realized I need to do something. The stock market had finished its collapse, at least I thought it had. But I realized I can't just leave my money in the bank. I need to do something with it. So that began a journey into trying to figure out ways to minimize downside risk. But the point of my story is that there is a time to invest and there's a time not to invest. The traditional financial advisors are not taught to recognize the top of the market or the bottom of the market. They always say, just put your money in the stock market, even though there is incredible risk that lies ahead. They could know or should know that. They just take your money and put it in the market. And people who do that at the wrong time lose a lot of money. Fortunately, I was not in that category, but I could have easily been. In 2009, 2010, I don't remember the date, somewhere in there, I did an internet search. I was curious about people who had figured out that the market was going to collapse before it collapsed. In other words, I was looking for people like the Joseph Kennedys of the world. And I came across a guy in my search on the internet, a guy by the name of Med Jones, and ended up engaging with him, talking with him. He's not an investment guy, he's an economist. And but he does follow the market and does some investing, but really as an individual, not as a professional. And this is a picture of him on CEO magazine, and the title of the article is "The Expert Who Predicted the Financial Crisis." There weren't many people like this. Yes, he's in the category of Michael Burry, but I don't know his methodology. I doubt it is as thorough as Michael Burry's was. But in that article, he had a quote. It is a very good explanation on why so many people and the mainstream financial advisors and investment companies missed the 2008 crash, completely missed it. We saw earlier Abby Joseph Cohen, global chief investment strategist for Goldman Sachs. I'm assuming she's telling the truth. She missed it. Of all the people, she should not have missed it. I want to read this to you and read it carefully, and I want you to think about it, because this summarizes really well what I think happened with people, particularly investment professionals, and why they tend to miss not just this, but other financial crises. There are two main reasons that caused mainstream economists and financial media to miss the financial crisis of 2008. The first is the NIH, not invented here bias, which is an organizational phenomenon manifested as an unwillingness to adopt an idea because it originates from unknown outsiders, also known as, I didn't think of it myself. It is a form of social cognition bias that leads to errors in group judgments, such as missing on new opportunities or risks. The second reason is a cognition bias known as the confirmation bias, which is the tendency to search for, filter in, or interpret information in a way that confirms existing preconceptions. The confirmation bias is recognized as an individual cognition bias, but when met with NIH bias, it appears to develop into a social bias very similar to the groupthink syndrome. And that summarizes, not just in 2008 or 2007, summarizes not only the financial industry at that time, but the financial industry through all of time. There is a lot of groupthink that goes on, and everybody's doing what everybody else is doing, just putting investors' money into the market and let it ride up and down with the market, putting in bonds to protect that risk, but killing rates of return in a bull market. And that didn't make sense to Med Jones because he categorized it as groupthink syndrome. It also did not make sense to me. I didn't know why it didn't make sense, but as I've done more thinking and more study, I now understand more why that's the case. But I will unpack some of this as we go forward. Jim Rogers is a colorful individual. Today, he is around 80 years old. When he graduated from college from Yale University in 1964 with a degree in history, he went over to Oxford to get a degree in philosophy, politics, and economics, and came out of Oxford and went to work for a firm in Wall Street. This would have been 1966. When he walked into the firm, the market was in trouble. It was not a growth market. It was, I won't say collapsing, but it was not going up. And many stocks were going down. But the stockbrokers and the people that worked for the firm were told to just push certain stocks. You push certain stocks. Jim Rogers looked at it and said, why would I do that? The chance of that stock going down is very high. So he immediately, as an outsider, began to look at the market and say, there is risk here, there is risk here. I don't know the whole story between 1966 and 73, but he endured that period of time on Wall Street, putting up with the bias that was just put people into the stock market. It's not that different today. In 1973, he was a co-founder of the Quantum Fund, and which was a hedge fund. and he took people's money and invested it in a way that he felt he could get the highest rate of return for the least amount of risk. During that period of time, beginning in 1973, I've already shown you a picture of 1973, there was nothing going up, not much. Maybe commodities were going up, but there was a lot going down. So he saw the opportunity to short stocks in the market. And that's what he did. He began the process of looking at what was the most overvalued and shorting it. I'm not recommending shorting or following Jim Rogers, but what my point is that he thought outside of the conventional box, which is promoted by every or many financial advisors with just put your money in the stock market. While his colleagues were pushing stocks on Wall Street while they collapsed, Jim Rogers was shorting stocks in the market. And from 1973 until about 1980 or so, until the age of 37, he made his investors over a 4,000% rate of return. And in the meantime, he made a small fortune for himself. At the age of 37, he took his money and left. And since that time, all he does is invest his own money. And of course, he appears on lots of TV shows. But he stopped investing for other people about 1980. In 2006, he said publicly that he was shorting home builders, banks, and Fannie Mae. Those happened to be the stocks that collapsed the most. And not unlike Michael Burry in the movie The Big Short. But he did that with his own money. He wasn't doing it for clients. So he is known today, and the reason he is asked to come on Bloomberg and CNBC is that today he is known as a guy who has knowledge or intuition about the direction of the market that is uncommon. And they always want to hear what he has to say because they know he's unconventional and he's independent in his thinking. He says today, or said recently, the next bear market, because he's seen several and made a lot of money during those bear markets, but he said the next bear market will be the worst in my lifetime. Because Jim Rogers, with his track record, is saying this, a lot of people take note of it. Now, of course, he has his critics, I'm aware of that, but he has gotten it right at times when many others did not get it right. Now I'm going to shift gears. I'm going to talk about interest rates. Interest rates are related to bond prices or bond fund prices. And when I say bonds, I'm referring to government, U.S. government, AAA rated government treasuries. As interest rates that are paid on these bonds go up, the bond prices or bond fund prices go down. And as interest rates go down, bond fund prices go up. This is important because these are used as a tool to that investment advisors have used for the last 40 years as a tool to offset equity risk. The benefit is it does a little bit, does some, to soften the rate of decline of stocks/equities when they are in deep decline. The problem, which isn't said very quickly, is that when stocks go up, those bonds are still present and the stocks are going down as interest rates are going up, usually in a period when the stock market is going up. So they work as a counterbalance for you and against you. What this shows is the inverse relationship between the rate, the interest rate that they pay, and the price of the bond or the bond fund. So you can see as the bond, the interest rates go up, the light blue line, the dark blue line, the price of those bonds goes down. You can also see from the period of time from about 1950 to 1980, that is a period where the dark line went down deeply. That was a 30-year period when bonds were in deep decline. And the only thing people wanted to talk about was stocks, not bonds. However, since 1980, 1981, 1982, interest rates have begun to decline, which means we've been in this long period of time, represented by the dark line, the end of the right side of the chart, where the bond prices have gone up and have been a decent way to protect against stock risk. However, they put a big drag on the rate of return when stocks are going up. But my point is to show the inverse relationship, and the good thing about them is that during a period when interest rates are falling, that bond prices have tended to go up. However, during this period, you see the period of deep decline of stock or bond prices while interest rates are going up, and then the reverse of that when interest rates have gone down, bond prices have risen. It creates a dilemma for the financial industry because virtually everyone in the industry has come into the industry or been trained during the last 40 years when bond prices have actually been an antidote to stock risk. And so the standard answer is, when it is thought that stocks are too risky, the very quick answer is government treasury bonds in this amount or that amount, this type or that type. But it has worked very well for 40 years. But when you look at that 30-year period prior to that, it didn't work very well. And going forward, I think we're going to repeat some portion of that 30-year period in the future. I'll explain. This slide shows, it's from the Federal Reserve Board's website, shows the history of interest rates going back to 1694. Well, this is not the U.S. bank rate. Bank rate is the rates that one bank charges another for the overnight funds, called the bank rate, overnight funds rate. It is from the Bank of England, but the U.S. today, for the last 100 years, the U.S. bank rate and the Bank of England's bank rate have tracked each other very closely. So we can use this as a surrogate for what rates have been in the U.S. and what rates probably would have been prior to 1913 when the Federal Reserve came into existence. There's some interesting things about this chart. It shows for a long period of time that the average bank rate, I'll call it the cost of money, has been about 5% per year at an annual rate of about 5%. Then the Bank of England and eventually the Federal Reserve Bank in the U.S. Became active in changing interest rates to stimulate or slow down the economy. And you can see the period when they didn't do that, and you can see the period when they did do that. In the middle of all of that, you can see that flat period is the period which is the Great Depression and World War II. Following World War II, in the early 50s, interest rates went up very high, up to around 17% for the overnight bank rate, and then began a decline, which I marked with a red arrow. And there we are today. At the far right of the chart, the interest rates have dropped from 17% down to near zero. So I ask the question, where do you think interest rates are going? Are they going down? They've got nowhere to go. Or are they going to go up? It is estimated by economists that there is a consensus that there will be 3 rate increases in 2022, and there will be an additional increase in early 2023. A total of 4 rate increases in our future, it is estimated. It is commonly agreed that interest rates are going up. Now, remember the prior chart that I showed you. When interest rates go up, bond fund prices go down. And when interest rates go down, bond fund prices go up. So if we are in a period of rising interest rates, it therefore follows that the U.S. government treasury bond is going to fall in value. If interest rates go way up, as they have in the past, bond fund prices will collapse. That's just the way it works. Now I'm going to shift gears again and go to a slide on inflation. Why is this important in investing? Well, it's important for several reasons. Because when you look at bond risk, you say, that's scary. When you look at stock risk, where stocks are today, you say, that's scary. Well, I don't know what to do. I think I'll just take the money and put it in the bank. The problem is the banks only pay, let's just say, let's be generous and say that you can get a 1% rate of return from the bank. A lot of times it's less than that. If you get a 1% rate of return, what about inflation? This chart shows that the Bureau of Labor Statistics publishes what they believe to be the interest rates that are currently, or the inflation rate today. The red line ends at the far right of the chart with inflation being today 6.8%. But the problem is they have excluded from this calculation the cost of energy and the cost of food. They have further added a substitution component to it, allowing them to substitute prices that get too elevated on one item, and they can substitute a similar item of lesser quality, so it shows a lower rate of inflation. I call that cheating. They call it substitution. So you've got substitution and you've got food and energy excluded. So the red line, in my opinion, is not a correct line. It does not represent inflation. A guy named John Williams goes back to 1980, and he began publishing papers back then and documenting the real rate of inflation when everything was included. It's now on a website. It used to be in newsletter form. But all of his white papers, which are published every month since 1980, are on that site. The blue line represents, according to his calculations, the real rate of inflation. The current real rate of inflation is about 15%, according to John Williams, shadowstats.com. I believe that. When you look around at the price of the things that we buy, for various reasons, they are escalating rapidly, and it is no surprise that the real rate is reported as 15%. When you go back over time, I'll show you in the next slide, you go back over time, this comes from the Federal Reserve website, go all the way back to 1959 to present. This is a way of measuring the real rate of inflation, and it's by measuring M2, which is the money supply, the amount of money in circulation. As the money supply increases, the value of those dollars correspondingly decreases. The more money in the system, the lower the value of the dollar and the greater the rate of inflation. And you saw from the previous chart, that goes up and down. But the money supply today is $21 trillion, most of it in digital currency, but some of it in paper currency. If you go back to 1959, I suspect in 1959 it was all paper currency. 0.28 trillion. So let's say $250 billion in money supply in 1959. In 2021, it is reported as 21 trillion of dollars, digital and paper, that are in circulation. That's an expansion of 73 times. This means that from 1959 to present, using this as a measure of inflation, which is reported to be a good measure of inflation, that the value of the dollar has declined about 73 times. It is that much less than it was worth in 1959. And if you go back to the cost of goods in 1959, or even in the 1960s compared to today, you can understand that the value of the dollar has declined dramatically and inflation has gone for a long period of time. That rate of inflation, when you look at that, is actually about 7% per year. So if you take money and you put it into your savings account, you get your 1% interest or whatever they pay you, the rate of inflation is 15%. And it is if you are writing a check to the Federal Reserve Bank for 15% of your deposit this year. So your dollars, it is a horrible investment. It is a known horrible investment because the dollars in purchasing power are being continually eroded. If you look at the far right of this chart, it's very interesting because you can see from the pandemic the amount of trillions of dollars that were pumped into the system to stimulate the economy. I don't know that it did that much good, but it did do some good. It kept us from completely collapsing. And the printed money escalated rapidly during 2020 and even during 2021. And so the value of the dollar is dropping rapidly. When they say the rate of inflation is at 15%, in my opinion, here's the culprit. As I said at the beginning, there are two primary goals in investing or investment management. One is, in my opinion, the first one is minimizing downside risk. The second one is maximizing upside growth when the opportunities present themselves to get upside growth. This is a slide that shows a 6-year period of time from 2003 to 2009. So it goes through two major macro market, or one big cycle, but two macro views of the market. The first is a rising market, we call it a bull market, and in general, the market went up during this period of time. If we were to look at this from a macro perspective, we would say this would be a risk-on environment. This is a period of time when people should be invested in the market. However, we get to an inflection point about October or so in 2007 when the market turns the other way and goes down. And it goes down, and it goes down hard for about 17 months. And that's represented by the red line, or the red circle. So the green circle and the red circle. So this is the first fork in the road. I call it an inflection point, a fork in the road where you need to decide as an investor, are you going to be invested in the market or are you not going to be invested in the market? And we call it risk on or risk off. So we will start with a risk on period. In the risk on period, so now I'm going to change the time period now to make my point. I'm going to change it from this long 6-year period, and I'm going to compress it down to a 6-month period. This is more of a micro period. So we'll look at this. And this is the exchange traded fund SPY, SPY, and that represents the movement of the S&P 500 index. So we can see during this 6-month period, the market generally went up. And if you were invested in the S&P 500 using SPY as our indicator, invested in SPY, then your investment would look something like this. There's nothing wrong with that. However, what we try to do is to break this apart and say, inside of the S&P 500, there are different types of stocks. There are 500 stocks inside of the S&P 500 index. And there are generally 2 types of stocks: value stocks and growth stocks. For example, value stocks, I'll just do this by example, they are companies like Boeing, Ford Motor Company, JP Morgan, Walmart, Costco, Johnson & Johnson. You would look at those, and some people call them old economy stocks. They're value oriented. In other words, they're primarily focused on growing profits. They want to be profitable, and they want that profit to increase quarter after quarter. They're interested in growth, but their primary interest is profitability. The second group of companies are growth companies. These are companies like Amazon, Google, Apple, Facebook, Twitter, and Tesla. Those focus primarily on growth. Yes, they want to have profits, but their primary focus is growth. So when you look at those 2 lists of companies, you'd say those are 2 very different lists, 2 different kinds of companies in growth and value. But the S&P 500 index contains both of them. They're both. If we looked at all the growth companies and all the value companies, we'd say there's a lot of both in the S&P 500 index. So as we tear apart that S&P 500, we say if our goal, or part of our goal, is to maximize rate of return, what we want to do is look for the index where the money, the big money, the institutional money, is going at that time. We don't know how long it's going to last, but we know that the flow of big money is going not just across all stocks, but into one type of stock more than the other. At times it is going to value companies, at times it is going to growth companies. We know that. So what we do is try to figure out which way money is flowing. And that's the direction we want to go as long as it lasts. It may last weeks, it may last months, it could even be 6 months or more. It's not going to be forever, it never is. It just goes for a period of time, and then big money, for whatever reason, finds better value in the other one, and it goes in that direction, and then back and forth. So what we want to do to optimize rate of return is to focus on which one of these is receiving the most money and growing the fastest at that time. I'm going to show you a couple of charts. We're going to take this period of time of 6 months, and I'm going to break it down into 2 periods, the first 3 months and the second 3 months. It just works out. Doesn't happen every 6-month period just like this. But this happens to work out in a way that will make my point. If we look at the first period of time is March 1 to June 1, a 3-month period. And when we look at a value index, the value index looks like the red line during that period of time. The blue line is the growth type index. And you'd say, it looks like the growth type index is taking more risk. It goes up and down more volatile, and underperforms the value index. You'd say, I'd rather be invested in the value index. Well, true, but only for that period of time. Because we always have to ask the question, where is money going? What's driving it? During this period of time, what is driving that value is the growth of those kind of stocks it's going higher in general than the growth stocks. On that very day, on June 1, for the next 3-month period to September 1, look how it changed. All of a sudden, what was value-oriented went out of favor very quickly, and now growth is in favor. So it's in favor because the flow of funds, the large funds, in U.S. stocks left value and went to growth. And we know at some point it's going to leave growth and go back to value. We don't know when. We're going to stay with this as long as it is in favor. So at this point you would say, boy, I want to be invested in growth. So there are times you want to be invested in growth. There's times you want to be invested in value. So what we do is we try to determine which one is in favor at this point in time as much as we can, and we try to make that switch, and we put our emphasis on that index and then the other one. Then we're ready to make that change at any point. If that flow of funds goes the other direction, we're ready to make that change and go the other direction. So let's go back to this first fork in the road. The first fork in the road, remember, was risk on or risk off. And if it's risk on, we just covered the second fork in the road, which was value or growth. Now let's look at the second alternative. If the fork in the road points at that time to we're not in a risk-on environment, we're in a risk-off environment, stocks are going down. So if they start to move in a downward direction and our indicator tells us we're in a higher risk period, then we change our strategy from being more favorable to risk on and that fork in the road to going risk off. When we're risk off, we use a set of defensive assets that favor risk off and are more protection oriented and than they are growth oriented. So we're not looking for growth, we're looking for protection at that second fork in the road. I want to take you through this slide because now I'm going to take this long period of 6 years and I'm going to compress it into a period of almost a couple of years. And the reason I picked this period of time because there are small mini cycles within this big cycle. There are periods of time during a crashing market where you want to be invested. In 2008, yes, 2008, you want to be invested in the market, but you want to be invested in the type of index which is in favor at that time, or at least emphasize that. And then, of course, there's times you want to be defensive. So let's look at, this comes off of our model. Our model is a hypothetical model that was developed because we didn't have money invested in 2008, so we work on a hypothetical model. Everybody does that. They build models and say this is the way it would have hypothetically worked. Next time it'll work a little differently, or we have an adaptive model or something like that. But in this model, this shows the following. We start at the left side of the screen and we see this goes all the way back to February of 2007. So we can see early on in March that the first green arrow says get invested in the market. We don't know what's ahead of us. All we know is that we're getting an indicator. And I place those green and red arrows at the place where the date when we got, as close as I could get it, to the date when we got those signals. So the signal was become invested in the market. So that's what we did, hypothetically. And then we rode that until get to a red arrow. And the red arrow says get out of the market on about that date. We get out of the market goes down. And during that period of time, we're in our defensive strategy. Green arrow, we don't know if the market's just going to keep on rising, go on back up, and go on for a long period of time. We don't know the future. All we know is we got to get, it says invest. And so we invest until we get a red arrow that says, there's a second red arrow, says get out. We don't know how far down. It goes down until we get a green arrow. It says go back into the market. And then we get a red arrow, the third red arrow, get out. Well, now the market starts to collapse. The first couple of red arrows, yes, the market went down, and we were glad that we were in a defensive strategy. The third one, we're really glad we're in a defensive strategy because now we're starting to see significant drops until we get a green arrow again and we reinvest. And then we get the fourth red arrow, again, it starts to collapse until we get a green arrow. And then the fifth green arrow says get back in the market. We don't know the future. We don't know what's going to happen. And then we get that fifth red arrow. And that's when the market totally begins its collapse. And it goes all the way down to that sixth green arrow. And we're in a defensive strategy. Not trying to make money in the market, trying to protect money. We get back in for a short period, and then the red arrow, get back out of the market or into a defensive strategy, and then the market finally finishes with its final collapse until we get to the last green arrow. And then the market begins its march back up, at which time, every time we get a green arrow, we're at that first fork in the road that says, do we go value or we do growth? We don't care which one, we just want to go wherever the big money is going. That's what we want to emphasize. So you may say, Ben, I understand that. That sounds good in theory. That makes sense to me. I like that actually. But how have you been doing? How have your investments been doing? Can you show me examples of what you have actually done? So this slide is designed to answer that question. We have recorded data in live accounts in real time, two approaches. One is a moderate approach with just full exposure to the market, and the other is a high performance approach with leverage in the market. We don't recommend the high performance model for most investors. Leverage is not appropriate for most investors. We do have some that use it, but I'll show you both. So this is recorded. This is data is taken from our fact sheets, and our fact sheets can be accessed through the performance tab on our website, reppondinvestments.com. When you click on performance, you will get these two alternatives for accessing this data. And this data was taken from page 2 of each of those fact sheets. Each month we update this to show current performance. I want to show you, so this shows both positive months and negative months, and it shows the total for the year. I'll start with the moderate strategy, so it's only for 3 years. So we have 2019, 20, and 21. And you can see in the blue box on the right side our performance for that period of time. Now, over time, over this 3-year period of time, we have taken about 2/3 as much risk as is in the market. With 2/3 of the risk, this is the rates of return that we've gotten in those 3 years. The average is about a 20% rate of return. I have highlighted in red on the left side of the screen, the upper left, the rate of return we got during the biggest risk period we had in this 3-year period. It is not a real test. The real test is yet to come. The real test will be when the market really truly collapses and we go into a bear market similar to the bear markets that I've illustrated in the past. If you believe that history repeats itself in some form, then we will get something like one of those in our future. But all we have to work with in this 3-year period is the month of March 2020. This is when the market began a decline due to the pandemic. It started in late February and went to late March. During that period of time, the S&P 500 collapsed in 5 weeks 33% in just 5 weeks. That was a very rapid decline. Our approach, by going into a defensive strategy, yielded a positive return for the month of March of 1.92%. That is an example. It's our only example for that entire period to show how have we been able to manage risk. And that is the best example of risk I can point to in that 3-year period. In the high performance strategy, it was 6.7% positive in a rapidly declining market. So that's our ability to show in real time as much as we can show at this point. Whenever the market gives us a true bear market, we will be able to show how we handle that as well. But this is what we can work with. The rate of return in the high performance strategy was around 40% for that 3-year period of time. If you have questions or comments, you can leave them below. If there are questions, I will try to answer them. You can also email me at ben@reppondinvestments.com or call me at 406-871-3321, and I would be glad to have a conversation with you. I would appreciate it if you liked this to hit the like button on YouTube, and if you want to hear my bi-weekly live stream, click subscribe and you'll be notified. And then finally, if you think it's helpful and someone could benefit, feel free to share it. Thank you for watching.